You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. Expansion sounds exciting. New patients, new staff, more revenue. But before a Medspa opens its second, or even third location, the foundation has to be right. Each new site adds complexity, it's more entities, more payroll, more intercompany movement, and a lot more opportunity for the books to go sideways if the structure isn't clear. These 10 questions are the ones you should ask yourself before you sign another lease or incorporate another business. They'll help you decide whether your current accounting setup can scale and what needs to change so growth feels organized and not chaotic. Number 1. How are or how will the entities be set up for your Medspa? Is your practice just one company, or do you operate with a professional corporation and a management service organization? If you have multiple locations, are they separate entities or all under one umbrella? Your legal and tax structure determines how many sets of books we maintain and how income, expenses, and payroll will flow. Ultimately, you'll want to discuss this with your business lawyer, and once you have both decided what the best course of action is, we can handle the books from that point forward. Number 2. How does your MSA define the management fee? Speaking of lawyers, this is again a necessary consult. Do they recommend a flat amount, a percentage of revenue, or based on performance per location? If your MSA was written when you only had one site, it may not account for growth, and you definitely need to double check with your medical director and attorney. The agreement should clearly state how fees are calculated across locations, so as the PC network grows, the MSO compensation scales with it. Best to tackle this point as soon as possible, because you never know when opportunities will arise. Be ready for them. At number 3, are your books already using class or location accounting? If you're transitioning from another bookkeeper to us, are your books already broken down by class or location, or will this be a new setup? QuickBooks Online can handle both, but if your prior books didn't, we'll need to discuss what the best date would be to switch over accounting methodologies. Mid-year conversions create reporting gaps, so aligning the change with your fiscal start keeps tax filings clean and your CPA sane, but if that date is too far off, compromises can be made. Number 4, how is payroll currently categorized? Does your payroll system allow departments or cost centers? Most major platforms do, but be sure to double check. Department tracking works like class tracking, showing which employees and costs belong to which location. Payroll should switch over at the same fiscal year boundary or whatever date we decided to sync up. Number 5, how are shared expenses divided between locations? Marketing, administrative salaries, and central office overhead, are they split evenly or by some other measurable like revenue or square footage? Having a fixed percentage rule keeps bookkeeping hands-off for you and consistent for reporting. Once the rule is set, it should apply the same way each and every month to make sure the P&L is meaningful. Do review your MSA as it may outline restrictions on how expenses are allocated. Up at number 6 is, how is your MSO structured in relation to each location? Do you have one MSO serving multiple PCs or separate MSOs for each? Both models work, but each requires its own bookkeeping logic along with separate books for each entity. A single MSO simplifies oversight and reduces your accounting costs, while multiple MSOs create flexibility but add more files, reconciliations, and intercompany accounting. Number 7, how will income be received for additional locations? Should the decision ultimately be setting up multiple professional corporations, then merchant accounts need to be created for each one to correctly report income to the IRS via 1099. This direction adds cost to your operations but can help with recognizing income easier and accurately without your bookkeepers needing to confirm revenue data with you on a routine basis. Side note, multiple professional corporations can further complicate your medical director's tax preparation. Number 8, how will each location be set up financially and where's the funding coming from? Have you found a leasehold to improve, or are you ready to start construction on a plot of land? Before going all in, think about how the build-outs are to be financed, perhaps through a bank loan, maybe paid personally by one of the owners, or even fronted by the MSO. If the funds are personal, they'll be recorded as capital contributions or shareholder loans. If it's a business loan, it needs to live in the right entity's books. Getting clarity here avoids misclassified equity and keeps ownership basis accurate from day one and helps you prepare for underwriting. Number 9, how will each location handle banking and expenses? Will each location have its own bank account and credit card? That separation makes class accounting cleaner and prevents crossover charges. For expenses that can't be separated, like marketing managed under the MSO, we'll still apply the percentage allocation we discussed before. Setting up vendor accounts and payment methods per location from the start saves time later and keeps reporting transparent. Number 10, how will your operations scale as you grow? Who manages what and where? Will you personally rotate between sites, or operate remotely, or centralize administrative work at the MSO with a dedicated office for all operations? Even 2 locations can stretch a manager thin. We know, we've seen it happen quite a bit. Defining roles, schedules, and trusted staff early, along with clear approval and communication processes, keeps your financial system scaling as smoothly as your operations. Each of these 10 questions connects back to one goal. Growth creates complexity, and without structure, your numbers stop reflecting reality. With clean entities, predictable allocations, and organized reporting, your books won't just keep up with your Medspa, they'll help run it.